Hello, I'm Sam Stovall, Chief Equity Strategist of S&P Capital IQ. In this week's Sector Watch, I discussed the performance of asset classes and S&P 500 sectors in a rising interest rate environment. The Federal Open Market Committee elected not to begin the tapering of its bond purchases this month. It did not, however, repeal the possibility of tapering altogether. As a result, at least two questions remain for investors. Was the sector rotation seen since May historically consistent with a rise in the yield on the 10-year Treasury note? And how have asset classes traditionally performed during such periods of rising rates? Since 1970, the average annualized total return during the months in which the yield on the 10-year Treasury note was rising showed that the cyclical sectors of the S&P 500 seemed to take the rise in rates in stride, while the more defensive, higher-yielding sectors reacted poorly. In addition, since 1976, the S&P GSCI Commodities Index performed well in a rising interest rate environment, advancing an average of 1.2% per month versus an average gain of 0.9% for the S&P 500 and an average increase of 0.5% for the Nareit Equity-Only Index. However, Barclays Aggregate Bond Index saw an average monthly decline of 0.7% when rates were on the rise. So when the Fed retests investors' tapered temperature, even though past performance is no guarantee of future results, don't be surprised if these same sectors and asset classes end up running similarly hot and cold. Please visit www.getmarketscope.com to view this report in full. I'm Sam Stovall, and I'll talk with you again next week.